What if every dollar in your bank account is slowly being turned into monopoly money, and the people doing it are telling you it's for your own good? I'm not talking about some conspiracy theory. I'm talking about math. Cold, hard, ugly math that central banks don't want you to do yourself. Gold just hit record highs. Again. Over $2,750 an ounce, flirting with $3,000 in some markets. And the financial media keeps acting confused. Why is gold going up when the economy is fine, they ask. Why are central banks hoarding it when stocks are at all-time highs? Here's what they won't say out loud. The system is breaking. Not tomorrow. Not in some dramatic Hollywood collapse. It's breaking right now, in slow motion, through a mechanism so boring that most people will never notice until it's too late. The U.S. government paid $1.1 trillion in interest on its debt last year. That's not the debt itself. That's just the interest. To put that in perspective, that's more than the entire defense budget. More than what we spend on the military, all the aircraft carriers, all the jets, all the soldiers, combined. And here's the kicker. That number is going up. Fast. Because here's how the trap works. The government runs a deficit every year, about 6 to 7% of GDP. That means they're spending way more than they're taking in. So they borrow. They issue treasury bonds. But to fight inflation, the Federal Reserve keeps interest rates high. Those high rates mean the government has to pay more interest on all that debt they're issuing. See the problem? They have to borrow more money just to pay the interest on the money they already borrowed. It's a loop, and loops like this don't end well. I spent hours looking at the Federal Reserve's own data, M2 money supply versus GDP growth. And what you see is this. The money supply is expanding way faster than the actual productive economy. That gap, that's your purchasing power leaking out. That's why everything feels more expensive even when the government tells you inflation is under control. Gold doesn't care about press releases. Gold is responding to the math. Let me give you a number that should terrify you. $315 trillion. That's the total global debt as of 2024. That represents 333% of global GDP. Think about that. The world owes more than 3 times what it produces in a year. How do you pay that back? You don't. You can't. There are only 2 options. Default or debase the currency. And governments will always choose the second one because it's invisible to most people. This is what's called fiscal dominance. It's when the central bank stops being independent and starts doing whatever the government needs to keep the debt machine running. They'll say they're targeting 2% inflation or managing employment. But what they're really doing is making sure the government can keep borrowing. And here's the part they really don't want you to notice. This already happened once before. In 2022, the US and its allies froze Russia's foreign exchange reserves. About $300 billion just gone, locked out of the system. Now you might think, well, Russia invaded Ukraine, so they deserved it. Maybe. But here's what happened next that nobody talks about. Central banks around the world looked at that and realized something. U.S. treasuries aren't actually risk-free. They're promises, and promises can be broken if you fall out of political favor. Gold, on the other hand, is possession. You hold it, you own it. Nobody can press a button and make it disappear from your vault. So what did they do? They started buying. A lot. Central banks purchased over 1,000 tons of gold every single year since 2022. That's the highest level of buying since the 1960s. China, India, Turkey, they're leading the charge. The People's Bank of China is particularly interesting because analysts think they're hiding a lot more gold than they officially report. We're talking potentially thousands of tons in accounts that don't show up in the official reserves. Why would they hide it? Because if everyone knew how much gold China was actually accumulating, it would spike the price and make it harder for them to keep buying. It's the same reason you don't announce to the world that you're about to buy 1 million shares of a stock. You drive the price up before you finish accumulating. Now here's where it gets weird. Historically, gold falls when real yields go up. Real yield is interest rate minus inflation. If you can get 3% interest and inflation is only 2%, that's a positive 1% real yield. You're actually making money in real terms by holding bonds. In that environment, gold usually loses appeal because it doesn't pay interest. But something strange happened in 2023 and 2024. Real yields went up, and gold went up too. That's not supposed to happen. That's the market telling you something has fundamentally changed. What changed is this. Investors stopped believing that U.S. Treasuries are truly risk-free. The debt to GDP ratio in the U.S. is over 120%. At a certain point, the market starts pricing in debasement risk, the risk that they're going to inflate away the value of the debt. And when that happens, suddenly gold starts looking a lot more attractive than bonds, even if bonds are paying interest. Let me give you an analogy. Imagine you lend money to a friend who's already drowning in debt. Sure, he promises to pay you back with interest, but you know he's broke. You know he's borrowing from 10 other people. At some point, you realize the only way he can pay you back is by paying you with money he borrowed from someone else. The interest rate doesn't matter anymore. You just want your money back in something real. And before you say, but the US would never default, you're right. They won't default in the traditional sense. They'll default through inflation. They'll pay you back, but the dollars will be worth less, a lot less. That's why it's called financial repression. They're eroding the real value of the debt at the expense of savers. Who gets hurt? You do. Anyone holding cash, anyone on a fixed income, anyone who believed the government when they said your savings were safe. Now, let me steelman the other side, because I'm not here to sell you gold bars. There are legitimate arguments against this whole thesis. First, Bitcoin maximalists will tell you that Bitcoin is the real solution, not gold. And they have a point. Bitcoin has absolute scarcity. There will only ever be 21 million Bitcoin. Gold, technically, can still be mined. If the price goes high enough, it becomes economical to extract gold from places we've never bothered with before. Bitcoin doesn't have that problem. Plus, you can move Bitcoin across borders instantly. Try flying with a suitcase full of gold bars and see what happens at customs. So the question is, does Bitcoin eat gold's lunch? Does the digital gold narrative actually play out? Because if capital flows into Bitcoin instead of gold, then gold's monetary premium could shrink, not expand. Second, there's the productivity argument. What if AI triggers a massive boom in GDP growth? What if fusion energy comes online and transforms the cost structure of the entire global economy? If real productivity skyrockets, and the debt to GDP ratio could actually shrink naturally. In that scenario, you'd want to own productive assets, stocks, businesses, not barren gold sitting in a vault. And third, there's the dollar milkshake theory. Despite all this talk about de-dollarization, there's no real alternative to the dollar for global trade. The euro is a mess. The yuan isn't freely convertible. The yen is weak. So as other currencies fail even faster than the dollar, capital actually flows into dollars, keeping the system afloat longer than anyone expects. These are real counterarguments. I'm not dismissing them, but here's what keeps me up at night. There's a massive discrepancy between the paper gold traded on exchanges like COMEX and the actual physical gold changing hands. On COMEX, you're mostly trading contracts, promises to deliver gold. Very few people actually take delivery. It's estimated that the leverage ratio is something like 100 to 1, or even higher. That means for every ounce of real gold, there are 100 paper claims on that ounce. This works fine until it doesn't. Until everyone shows up at the same time asking for physical delivery. What happens then? The exchange declares force majeure, an act of God, and settles in cash instead. You get dollars, not gold. And if that happens, If there's a run on physical gold that exposes the paper market as a fraud, the price could gap up overnight. We're talking about a potential moonshot that makes the current run look like nothing. I can't prove this will happen. But the setup is there. The incentives are there. Do we really believe it's a coincidence that the countries buying the most gold are the same ones trying to reduce their dependence on the US-dominated financial system? Do we really think it's random that gold keeps hitting new highs right as US interest costs cross $1 trillion? Here's what I think happens next. And this is where I could be completely wrong. But let's game it out. Scenario 1. We muddle through. The Fed finds some magical sweet spot where they can keep inflation just high enough to erode the debt, but not so high that people panic. Gold stays elevated, but doesn't explode. Bitcoin continues to siphon some of the safe haven demand. Scenario 2. A crisis forces the Fed's hand. Maybe it's a debt ceiling fight that goes wrong. Maybe it's a foreign buyer strike, where countries just stop buying treasuries. The Fed has to choose between letting rates spike, which would bankrupt the government, or pinning rates artificially low and letting inflation rip. If they choose the second option, gold goes parabolic. Scenario 3. The productivity miracle actually happens. AI and energy breakthroughs create real growth that outpaces the debt spiral. In that world, gold underperforms, and you'd rather own equity in the companies creating that growth. I don't know which one we get. Nobody does. But here's what I do know. The people running the system are increasingly boxed in. Their options are narrowing. And when powerful people run out of good options, they start making desperate choices. The gold price isn't just a number. It's a vote of no confidence. It's the market saying, we don't trust the trajectory we're on. Should you buy gold? I can't answer that for you. But ask yourself this. Do you trust that the same institutions that got us into this mess, $315 trillion in global debt, negative real rates for a decade, money printing on a scale never seen in history, do you trust they can finesse their way out without consequences? Because gold says no. And more importantly, the world's central banks, the people who actually run the system, are saying no with their wallets. They're buying gold like it's 1971 all over again. Maybe they know something we don't. Or maybe they just did the math.